Good morning and a big welcome to you all on this bright and sunny morning. My apologies for those of you who had to wait a couple of minutes. We've had some technical challenges, but I'm pleased that we are over them. I'm really pleased that you could join us for this latest webinar in our DAC6 Academy series. This webinar is being hosted in collaboration with our partners, WTS Global. So please do use the chat function on the right of your screen to introduce yourself, and do let us know where you're from. Please do also post any questions that you may have for the panelists, as well as your insights and comments as the webinar proceeds. And should you miss anything, don't worry, you will have access to the on-demand recording straight after the webinar. I'm Ali Kazimi of Hans UK, and I will be your webinar moderator. I've been in the financial services tax industry for over 25 years now, and DAC6 is by far the most technically complex automatic exchange of information regime that we have seen to date. And today's webinar will specifically look at the challenges that are faced by hedge funds and their managers, and a little bit also on the service providers who support hedge funds. We will look at what are the technical issues for hedge funds, managers, and service providers. We'll look at the role that trade associations have played, particularly following the deferral, and also round off by discussing how you can mobilize and operationalize DAC6 implementation in your own firms. We will intentionally not delve too deep into the peripheral areas, nor do I intend for us to seek to cover every matter that is being attended to by other webinars in our DAC6 Academy series. Firstly, and I am also hoping that Anna Shill of BBH will be able to join us. As I mentioned, there's been a few technical challenges we have experienced this morning. With that, I would now like to invite both John and Robert to introduce themselves and tell us a little bit about their organization and what work they've been doing in relation to DAC6. So, John? We've just lost John. As I said, we've had technical issues. Why don't we start with you, Robert?
Thank you very much for the kind introduction, Ali. My name is Robert Welzel. I'm a tax partner with WTS. We are, let's say, German-based tax consulting. And myself, I've been for more than 25 years in the area of tax consulting, especially in the with financial institutions from a broad range. So very often my perspective is if German investors are investing on a worldwide basis, what topics they face, especially if they invest in hedge funds, as Germany is not the per se #1 hedge fund location, to put it this way, but from a reporting perspective and also from a, let's say, on a trading perspective, cum-ex and all these topics, let's say there's this very strong interest, at least from the German officials here, to tackle mandatory reporting to gain sufficient information from a policy perspective.
Excellent. And John, we were just going to go for introductions.
Good morning. As John Billige, I'm the Tax Operations Director for State Street Global Markets in London. We've been spending a lot of time on DAC6, primarily looking at all of our business models within global markets and trying to really assess the potential risk that the regulations pose to our businesses and the industry. It's a very sort of challenging set of regulations, and specifically at the minute, with guidance being, I think, in pretty short demand. But new things are still emerging. For example, branches having to report in the head office jurisdiction. That one of the things that we just recently come up against as a challenge. But other than that, I cover sort of FX, global link platform, securities finance, and our we used to have a broker-dealer business, but we had that as well. But yeah, so happy to give as much as I can today with regard to this challenging regulation.
Well, thank you very much, John and Robert, for joining us today. One thing I wanted to do was, obviously we've got a loyal fan base who always dial into these DAC6 Academy webinars, but today we have a number of new audience members, and I just wanted to welcome them to the new joiners. And also what I wanted to do was just sort of like give a quick brief introduction to DAC6, just to make sure that we're all on the same page. So DAC6 is an EU directive that has been transposed into UK domestic law, and to supplement the UK's DAC6 regulations, HMRC has also undertaken several rounds of consultations to clarify exactly how the directive will apply in practice. And the DAC6 regime essentially imposes mandatory disclosure of cross-border arrangements which meet one or more specified hallmarks. Cross-border arrangements are arrangements which generally concern either one or more EU jurisdiction or a EU country in a third jurisdiction. So all of these type of arrangements are in. So it's a very, very broad piece of legislation. The rules are, quite similar in structure to UK's existing OTAS, or disclosure of tax avoidance schemes regime. So those UK tax advisors should be familiar with how it operates. However, the key thing is, whereas DOTAS was purely restricted to domestic law, DAC6 is by definition restricted to cross-border arrangements. And the DAC6 hallmarks are extremely widely drafted and apply to cover in-scope EU taxes. DAC6 reports must be lodged by intermediaries. These are usually advisors and service providers which facilitate the arrangements. Or where you don't have a disclosing intermediary, it could be the taxpayer themselves who are obligated to report. And this can arise when, say, for example, a solicitor is prevented from making the disclosure because of legal professional privilege. Now, this discussion can be quite broad-ranging given the wide scope of the regime. So what I propose to do is to look at issues essentially in three broad tiers. So starting with, first of all, the investors into the hedge funds, then talking about the fund structures themselves, and then finally we'll talk a little bit about the investments that are made by the hedge funds. And we will conclude our discussion by looking at some of the practical aspects of how to become compliant. So with that, I'm going to start with you, Robert, and ask, Germany boasts some of the largest and most numerous single-family offices across Europe. Okay? And many of these family offices are investors in hedge funds. So what do you see, what DAC6 challenges do you see in relation to hedge fund investments?
Let's say, first of all, we have to take into account, as I already mentioned via my short introduction, Germany is not the place or not the jurisdiction per se for hedge fund managers or hedge fund structures as such. So usually German investors, either family office or offices or institutional investors, they usually invest into, let's say, non-German fund structures in such a case. And therefore we have a very diverse fact pattern. First, we have, let's say, the typical US Cayman structure with no specific, let's say, EU nexus. Then we have the US structures with either Luxembourg or Irish feeder structures. These are typically very often the setup to invest into international hedge funds. And at this point, if you invest, let's say, as a German investor into an into a non-EU hedge fund structure with no EU nexus at all, there you wouldn't face, let's say, this is at least my current interpretation, you wouldn't face any reporting obligations. But if, let's say, the international fund structures have set up specific feeder structures, Luxembourg, which really aim to attract a certain type of investors to optimize, let's say, the tax returns for investors, the investor family office or internally, they already have to make a decision which feeder structure they choose. And on this level, this already triggers the question whether the decision to invest in a certain structure is reportable, yes or no. From a German interpretation, it is quite likely that these, let's say, decisions how to invest into, let's say, hedge funds is already very often triggering, let's say, reporting topics. Yeah. And then you have the second question. If you are invested in structures, either with a EU nexus or where the, let's say, on the investment level you have a EU nexus, who has to report and what is reportable and what is, let's say, the qualification of the German investors. And very often in hedge fund scenario and in international interpretation, not the fund as such may be, let's say, reportable, because it's a flow-through vehicle, partnership structure. It is not within the understanding of the, let's say, EU directive, the relevant taxpayer. It is more or less the investor is the relevant taxpayer. But there we have, let's say, at least in Germany, some good guidance that fund structures, especially if they are not set up specifically for one investor, but for a broader range of portfolio investors, will qualify as, let's say, the so-called user. Germany has modified, let's say, the relevant taxpayer to the term, or introduce a new terminology for the relevant taxpayer. It's the user, and fund structures usually per se will qualify as users. So the relevant reporting may be from a user perspective or from a relevant taxpayer perspective with the, let's say, structures, with the fund structures themselves. At first glance, this seems to be quite, let's say, difficult, because suddenly the fund structures may face a reporting item. But on the other hand, this will shield the investors, let's say, relevant taxpayers to be reported on a individual basis, because this reporting item can be, let's say, has to be taken up, will be taken up by the fund structures itself, and therefore shield the at least German investors that they have to, let's say, from some responsibility to conduct any reporting if there's no reporting on fund level or from any intermediary, etc. So this is a beneficial item.
That's very interesting what Germany's done. Do you wish to comment, John, about the feeder structures and the choice there?
Well, I guess it really depends if we're looking at, say, a hedge fund into a Luxembourg structure. Particularly, I think the Cayman hedge funds, and Cayman itself at the minute, as we know, has since February been on the EU blacklist. And whether it remains on there until the end of the year is uncertain, I guess. One of the challenges really for these types of structures where you you might have a Cayman hedge fund going into a Luxembourg platform is, whether that listing goes into next year, and the proposed defensive rules that the EU would like to bring in from January next year, that would create certain issues for a hedge fund, for example, using a Lux platform with regard to additional costs, such as the Luxembourg payments from Luxembourg, might not be deductible. There could be additional withholding taxes. But outside of that aspect, under those defensive rules, I think generally being in that scenario at the moment, whether there's any more extra due diligence required under either the mandatory disclosure rules or DAC6, which are pretty much similar anyway, is a challenging time, I think, for third countries, specifically blacklisted third countries, moving in or operating within these types of European fund structures. But it's interesting.
That's quite interesting because, for a long time, what you had is hedge funds would set up these treaty platforms in places like Luxembourg. And these are the good old days when you could basically, an advisor would say, let's set this up, give the treaty access to essentially hedge funds. And in the afternoon, you could go to the Lux authorities and they would sort of like give you a ruling. And, you had this whole structure. Now, the interesting thing from my perspective is, the developments, particularly around, say, for example, the wider BEPS project. And you look at Action 4, specifically the rulings on treaty shopping. And, where we have gone with the principal purpose test, as well as the substance requirements. I think, there's just so much happening in that space that those type of platform structures are very vulnerable. But as you sort of like point out, John, that their position vis-a-vis, the new rules that are coming in, that would essentially render it. I mean, if that was the last nail that was required in the coffin, I think that would probably be it.
It's interesting, though, the draft legislation in Luxembourg specifically, I believe, excludes transparent hedge funds, Cayman hedge funds, for example, where there's a partnership involved. So obviously, I think as we were discussing, I think the other day, is that when you get the transparency factor into it, you are looking through essentially, you may be looking through essentially who those partners are, and where they are resident, for tax purposes, and to point, about treaty shopping, whether there's any aspects there that would be relevant to those partners. And that sort of brings in the point about under C3 of DAC6, relief from double taxation. That's an interesting aspect as well, that's sort of similar to what you're saying there around treaty shopping.
And with treaty shopping, I think we are already really triggering one of the, let's say, tax planning issues. The European fiscal authorities want to get more knowledge or want to receive more information. And there's a question then who has to report, who is relevant. And I think, let's say, the fund structures as such, probably not, but the portfolio managers, intermediaries such as lawyers and tax consultants, and last but not least, probably prime brokers, etc. Some knowledge test may be necessary, and so on, what your clients are doing. And this will, let's say, especially in this area of hedge funds, with many intermediaries in different jurisdictions working together, there might be diverse, let's say, a range of intermediaries or reportable entities who have to report.
And that's quite interesting, Robert, because I think, I know you mentioned that Germany has, for a better word, taken a purposive approach and treated the fund itself as the taxpayer.
Yes.
Now, that's, from what I could gather, you're saying that both is tax opaque as well as tax transparent funds. That's the taxpayer. Now,
Yes.
That's not a view that is held in the rest of Europe, because we have had situations whereby, you've got the fund structure itself and you've got the hedge fund manager, and we're not even talking about the service providers, the prime brokers, and so on. Now, who is a relevant taxpayer and who is an intermediary isn't always clear, because I have certainly seen that in certain cases, and particularly, say, for example, if you've got a tax transparent structure, they themselves could be an intermediary. So they may not be a relevant taxpayer, but they're an intermediary. So you've got two tiers of reporting obligations. And this is the kind of entity analysis that DAC6 requires, whereby both the hedge fund manager as well as the fund itself could be intermediaries and have dual reporting obligations.
Yes. From a perspective here, let's say if you qualify the funds as a user or as the relevant taxpayer, then the manager very often will be or the management company will be the intermediary. And if they have some EU nexus, either via permanent establishment or etc., they or business activities in a broad range, they are the intermediaries, whereas then the fund has if the intermediary reports, let's say the information for the user or the fund have to let's say to manage with its tax authorities or with the tax authorities is very limited. Whereas if the manager is regarded as the intermediary and not the fund as the user or the relevant taxpayer in the various jurisdictions, then you have to look through to the ultimate investors. And this will trigger, let's say, additional burden, responsibilities on the level of the investors, no doubt about it. And of course, there's no clear, there you have to look for every jurisdiction or analyze jurisdiction on a case-by-case study, because, let's say, the German approach here, it is to make this has been established for simplification reasons, but yeah, on the other hand, then it triggers reporting obligations with the funds, which at first glance it is not very often of the interest of the market participants, of course.
Yeah, it's interesting that when you look within DAC6, the main parties that are relevant here are the relevant taxpayer and the intermediary, with the intermediary falling into effectively two categories: one of being a service provider and one of being, a promoter. And that's it. Absent an intermediary, the relevant taxpayer has to report. But generally, I think jurisdictions will be looking at intermediaries moreover to give them the information they need, depending on how the regulations are implemented in those jurisdictions and what the local guidance says around what an intermediary is. Interesting.
I mean, it's for us being based in London, which houses both investment managers and often managers who have got, say, regulatory license here who are sort of like, performing things for a hedge fund manager that's based in, say, New York or whatever, or Greenwich or whatever, under a sub-delegated power.
Yeah.
And that potentially, and the default position generally, as you say, Robert, is that the manager is seen as the intermediary with the obligation to report. Now, what we're also seeing is that through a sub-delegation process, not only is the business that's being conducted through the London offices being brought into scope, but depending on the structure, and if it's a branch structure, it is also bringing into scope other investors with the EU nexus through the London office.
Mm-hmm.
And that's created some sort of like, again, the widening of scope. And I think we can't just sort of like immediately say there's nothing to, do unless that analysis has been conducted.
Yeah.
So it's quite broad. I mean, sort of like the definition of intermediary and how they bring into scope.
Yes.
Now,
And what I think I do not want to, let's say, promote here the German solution, but is especially in the hedge fund arena or other alternatives investments, if you have to report or if you have as an intermediary the reporting obligation, you also have to mention who is the relevant taxpayer, and then it gets very individualized whom you have to let's say report to the tax authorities.
Yeah.
Whereas, let's say, the German concept at least gives some shielding of the ultimate let's say investors, so that the ultimate investors are not reported directly, let's say, to the tax authorities, and to and therefore are individualized on a, let's say, general EU databases.
Yeah. One thing I just want to also just say is, at a very practical level, what you're getting a lot of debate in the London market is around, say, for example, the managers. Quite often they'll say, well, yes, I may be an intermediary, but I'm not really going to do anything about it because I'm relying on the service provider, the administrator, to do it all. And you speak to the administrator and they have a different view of things. And particularly sort of like if you've got an administrator, say, for example, in Luxembourg, because Lux-based administrators, they are covered by what's termed the legal professional privilege, and which basically means that they do not have to report. So it's defaulting back on the manager. So I think there's a real interplay that's going on between the managers and the administrators, and quite often it hasn't really been overtly discussed. I mean, Robert, do you see any of that? I mean, particularly sort of like with some of the Luxembourg very wide definition of giving legal professional privilege to different intermediaries?
Yeah, let's put it this way: if you are an intermediary and there are various or there are multi intermediaries within a structure, per se, every intermediary has to report by himself. So they can only rely or do not have to report if they can clearly, let's say, refer to another intermediary who has already reported the whole structure, etc. So if you have various intermediaries and part or let's say one of the intermediaries, either by let's say professional secrecy regulations, do not have to report, then the fallback is with the let's say with the manager, and or the other intermediaries, let's say, as you indicated, administrators or probably prime brokers or whoever, they have then to report too. And let's say, of course, these intermediaries, they can arrange that only, let's say, one bespoken communication with the tax authorities will take place. But this is, let's say, what they have to arrange for. And what we saw here, let's say, in Germany, due to for the backlog, it is very difficult to arrange this on a short-term basis. So let's say going forward, I think there will very significant improvement of the communication between the various intermediaries, what they report, and that only, let's say, at least one intermediary has to report. And in case of professional secrecy, at least Germany took the regulation. Let's say, law firm, tax consultants, they have to report on an abstract level, but with more or less all the details, and the relevant, let's say, taxpayer or the user has to conduct the reporting by himself too.
Yeah, so that's quite interesting, and I will come back to the prime broker discussion in a minute. But actually, let's pick it up now. I mean, John, I mean, one of the, with so much of the activity that the fund puts through the prime broker,
Yeah.
I mean, clearly, the prime broker has the visibility to see all that the fund is doing.
Yes.
Now, so, because I'm just looking, so you've got either the manager,
Mhm.
or you've got the administrator, or you've got the prime broker who's basically picking up the responsibility.
Mhm.
I mean, and then we've got, obviously, as you said, there's two types of intermediaries. There's the promoter, which probably would be the manager, but you've got the service provider category that's applied to prime broker, I would have thought. But would that sort of like make sense to you to sort of like leave it with the prime broker?
Well, I think if you follow the principle of, I mean, DAC6 was sort of came out of MDR, and MDR was sort of to do with common reporting standard and financial accounts. And if the prime broker is really sort of holding the financial accounts on behalf of its clients, then it's going to be in the service provider category anyway, not necessarily promoter. So it would have, I think, a direct obligation as an intermediary to report anyway, should something become reportable, because the prime broker is helping the fund with its strategy. It's helping it move into the market. The prime broker's doing quite a lot for that fund, whereas the fund or the IM is sort of obviously dealing with the investors and creating the funds they want to deal with and trade. And then they need a market access to do that, which is unless they're going direct, which is your prime broker. So, the prime broker would hold, I think, the primary intermediary obligation, but it could also then flow down into the other aspects of the funds themselves, depending on what they're doing and which jurisdiction they're in, and whether that jurisdiction requires, reporting of them, or whether they could just be reported by the prime broker and that's the end of it. So their obligation, should it be there, is extinguished.
And could it be, I mean, because I'm just thinking, as I said, it's like a wedding cake that you got three tiers that, when it comes to, say, for example, the investments of the fund, that clearly there is visibility by the prime broker at that level. When we talk about higher tiers, let's say, for example, the investors coming in, that would be the transfer agent or the administrator who will have sight of that, or maybe a lawyer.
Yes.
And even the establishment of the fund itself, as to how the fund is structured, it's unlikely that, the prime broker or the administrator may not have sight of that. That would probably be sort of like tax consultants, lawyers, and accountants who would have. I mean, you could potentially get into what, if I can term, the primary intermediary who takes the responsibility. But depending on what the activity is, it may default to different types of intermediaries take responsibility.
Yeah, I mean, to the point of the prime broker, I mean, when it's onboarding a fund, that's where the financial account ought to be, and obviously the KYC aspect of that and the prospectus that the fund would issue would give some indication as to its nature and what it's trying to get to, and how it's marketed. But you wouldn't necessarily see, for the prime broker, necessarily see through that. IM. The only time that you would actually see something like that is, and that's not really a subject for this discussion, but just as a note, is like the transparent pooling structures, where you get transparent funds coming into the market acting for underlying pension schemes. You would see those investors, because that's the ACS, for example, in the UK is designed specifically for that. But generally outside of that, where the fund is coming into the PB, you're right, it could be difficult to see through. And where does the reporting obligation as an intermediary effectively stop? That's interesting.
And I think one of the problems that I can foresee is there being a real problem, because you've got multiple intermediaries and many of them are not moving and just waiting for the others to move. That, a bit like what Germany forced on everyone by the deadline, that, as we approach the reporting deadline, then everybody will run towards the door and say, oh, we have to report because we have a legal obligation. But at the moment, everybody's watching by the sidelines. And what I'm finding is sort of like administrators haven't yet spoken to their hedge funds, and vice versa. The real imperative that I'm seeing coming through is usually fund board, the board of directors of the funds, who quite often sort of like hear about DAC6 and then they drive the process, even though the fund is probably, as Robert sort of like the German equivalent is that they're the taxpayer, yet they can often set the pace. So, who starts the process or gets the ball rolling towards compliance is going to be one of the issues that needs to be attended to.
That's interesting, because that's where the intermediary that's responsible for DAX, when you're in the category of an intermediary and you're within DAC6, should you have a reportable arrangement? That sort of thing would have to be escalated, internally if you see something that's not right, or you feel that the further on investments are being used for something spurious, then that requires a potential DAC6 reporting, or just a view on DAC6 reporting. You've only got 30 days to do something. So generally the escalation processes would need to be ingrained in businesses that help sort of the front office guys or non-tax people getting to tax people within the organisation to say, look, we've got this, we're not sure about it, and then a decision's made about what should happen. So to your point about waiting to see what happens and not having visibility, that's absolutely true. You can't see through the chain of intermediaries, but the problem with DAC6, it imposes that transparency requirement that isn't there.
And I think that's what Robert, you can probably point towards what happened in Germany, sort of like you've passed a reporting deadline kind of thing, because the way I see it, as John's alluding to, is it's not so much the tax technical aspects as to which hallmark we're looking at or not, but the fundamental issue as to which intermediary is in play and what the obligations are. Yeah. Those protocols just have not been put in place. And you'll get the odd enlightened sort of like fund house or intermediary or administrator who takes the lead. But, it's just a problem that's just waiting to blow up.
Yes, it was especially a question for the backlog, and let's say other jurisdictions still have these issues. We are in Germany here now going forward, and what you indicated, you have multiple, potentially multiple intermediaries with different level of knowledge of the very specific structure, and then let's say everyone has or could report by himself. They just have to inform the user or the relevant taxpayer. Not even the other intermediaries have to be notified. So it is really a question of communication, because the ultimate aim for the fund promoters should be that they have a consistent, let's say, communication with the tax authorities, and thereof consistent communication with their investors, and that it is ultimately, from my perspective, a reputation topic. If you are the fund promoter and you have different, let's say, streams of communication which are not aligned, and ultimately all these informations will hit let's say the investor, especially in let's say in many jurisdictions via tax audits, because the tax audits will be, or the tax auditors will be informed, and they will get hold of all these information, and then the investor or any intermediary is already, let's say, in a weaker position to negotiate with the tax authorities what was the intention of the overall structure and so on. And so it is really to build up the communication links, first internally, but with the various business lines, but especially in the hedge fund, let's say, arena with the various potential intermediaries.
Yeah, I think that there's a genuine risk of over-reporting, and as you say, Robert, about this, if you're on the back foot, then once the audits start, that's really when the music will, begin to play, and that's going to be a real problem. So I think not planning now is just storing up trouble, downstream, which certainly we do not want to be subject to tax audits, which, unless we get this sorted out, it will result in, because what you're going to get through the multiple intermediaries is inconsistent information, and that's really what tax authorities look out for when it's incoherent or it doesn't match up. But I'm going to just sort of like
Ali, to that point, if I may say, what in consultation with the revenue and in the HMRC and in the guidance notes, where you've got a series of intermediaries, something needs to be disclosed and reported. The revenue wants to see all of it. They don't want to see bits of it, and that's one of the biggest challenges, trying to get it all together, because they want to see the thing in the round. They don't want to see a little bit here, a little bit there. They want to know exactly what's going on. So the coordination between intermediaries to report the relevant facts, leading to how it started, where it went, and where it ended up, is very important. And I think one of the massive challenges for the industry to know that if someone's reported on behalf of someone else, that they've actually reported what they should be reporting. And with the 6 months delay due to COVID, we're not going to really see what's going to happen next year about reporting.
Very good.
So it's going to be, I think it's going to be a mess personally, but we just have to wait and see what comes.
That's the German problem, because I think what happened was in Germany, you'd correct me, Robert, is nobody did anything for a long time. And then 2 weeks before the deadline, then everybody starts reporting. And, you just know when they lost their bottle.
Yeah. Of course, let's say we were a little bit. No one, as you outlined, no one really expected that we have to report end of August, and so it was really a last rush. But I think what is and John already indicated, you too. Let's say it is not DAC6 reporting. Of course, it has been implemented that on a European level, the politicians will get sufficient information probably to be proactive about certain transactions. But in Germany, had been additional reporting be implemented. And there's a clear understanding of the tax authorities that they want to get the information to, let's say, especially for the tax audits, so that the tax audits are very well prepared or are better prepared than in the past, that they do not have to re-engineer the very often, from a technical perspective, quite difficult structures, so that they will be informed, get upfront information, and being on the more or less better same playing field with the let's say with the investors or with the taxpayers, and then can really look very quickly into the, let's say, put it this way, interesting tax technical questions, substance over form, and all these issues which might be on the agenda. And therefore we have.
I'm just conscious of time. I'm going to raise just a question for you, Robert, in connection with that. We've just had one of the participants, Keith Tate, ask a question, which I think is really pertinent. Is, with UK, exiting the European Union, Germany relative power has increased considerably in setting the agenda for the rest of Europe. Now, Germany itself, particularly with the the issue that happened with the deferral or the non-deferral in Germany, has the German political situation, the elections coming up, has that kind of settled which direction Germany is going to take, and then ultimately set the agenda for the rest of Europe? Or, are they going to be hard on the tax front? Are they going to be soft, or, be purposeful? Because UK was always, sorry to say I'm sitting in Britain, but we were always a moderating kind of force, always on more leaning towards the side of the taxpayer and businesses. Now, are we going to see a harder German approach?
Probably. Let's say, as indicated, Germany per se, or the German policy, had been to they recognized that DAC6 is a very effective tool to gain transparency and gain better understanding of the overall structures. No doubt about it. And let's say, therefore, to be more effective via, let's say, tax audits. No doubt about it. The let's say why we didn't, or let's say for the why we were front runners, let's say, for the reporting, as what you hear, it was the single decision of the Minister of Finance, Mr. Scholz, and that's it. It was a political.
So it's an aberration.
It was a very unexpected political decision, short-time political decision he took. Yeah. So, yeah.
Thank you very much. I'm just going to turn very quickly. One thing we haven't discussed much is really around the investments that are made by the hedge funds. So I'll ask John more on the securities side of things. You know, we talked a little bit about the risk of over-reporting, and you know, in the context of, say, for example, where you've got a prime broker and there's, say, for example, rehypothecation, there's securities lending transactions taking place. I mean, where do you see that whole thing going? I mean, I know you've been party to the discussions that the likes of AFME and ISLA have undertaken.
Well, in relation to sort of taking collateral, I mean,
are we just going to get reams and reams of information hitting tax authorities? Because a lot of these transactions, some would say that a securities loan is a circular transaction by definition. We've lost John. I'll go to you, Robert.
You can answer the question by yourself, Ali. You can answer the question by yourself. I know. So it's switch from moderator here to panelist too.
No, I'll ask you, Robert. About
I've got it.
Oh, sorry.
Hello. Yeah. Okay. So yeah. I mean, there are sort of
the P2 circularity and so on. And
yeah.
Recharacterization.
Well, I think that for sort of institutions that are involved in sort of temporary transfers of securities in whichever form that might take, you need to look at what your sort of service model is. It's generally you find that majority, nearly all cases, the model itself isn't designed to procure a tax benefit. But that's not to say that down the line there could be something going on where a tax advantage may have been sought and obtained. So generally for your BAU, your business as usual stuff that we're seeing on a daily basis, none of the hallmarks ought to really apply unless something sticks out like a sore thumb, and you then have to sort of work out, well, what actually is that problem? But you're right. I mean, around sort of transfer securities with regard to taking collateral, you've got the circularity test, you've got the recharacterization of income test, which could apply similarly to the transfer of the securities themselves as a loan or a repo. You've got the same principle in that, are you sort of receiving a manufactured income back in a recharacterization, in a recharacterized form that gives the lender an ultimate uptick on tax? Are they not going to pay as much of income tax on that particular character of income, whereas they would have paid on the dividend? But so I think a lot of that understanding and working through is internal due diligence and tax risk management around your product, your new clients, your new ventures into different jurisdictions. All of that requires an analysis on a sort of a look-through basis of what the borrower is doing, whether it's best you can find out how the lender or intermediary is acting, what it's doing, what its knowledge base is, who the client is, what would be the impact on them if certain income streams were to be received. Is it tax neutral? What are you going to be subject to any withholding on the payments that they make to you as the service provider? Does any of that fall within DAC6 reporting? Sorry.
I was going to say the summary of it is, we have taken a pretty purposive approach, and generally flow business, we're not expecting it for it to be in DAC6.
No, but that's it ought not to be. But that's my point, I think, earlier about over-reporting, in that next year is, the industry can take a view jointly that this is where we are. And I think that when you're looking at representations like UK Finance, AFME and ISLA, the general consistent message is that our BAU stuff is okay. But if we were to see anything that triggered a concern, you escalate it. Yeah. And one of the things that HMRC were very strong on, although they don't give you actually guidance on how to do it, is having an appropriate escalation process in-house. Yeah. Because if you need to get to the tax people, you need to get this stuff recognised and dealt with, and you've only got a short period of time in which to do it. And that's where the reputational risk is, I think, for businesses, is that if they miss a reporting deadline and they're acting, say, as on a fiduciary basis for an underlying client, for example, that client could be caught up in reporting when it wouldn't ordinarily expect to be.
Yeah.
So
Now,
for hedge yeah.
I was going to say that's really interesting, and I just want to hear it, Robert, because one market that's causing us a lot of problems in the London market is actually Germany, and the view is that unlike what John's been saying, Germany's taken a far more stricter approach, and potentially people are talking about every loan transaction, securities loan transaction, or a derivative sort of like synthetic return could be potentially in return. Is that what you're hearing or seeing?
I wouldn't be. Let's put it this way: the normal or standard transactions are not, let's say, or I would put it this way: the per se a securities lending transaction as such, even if over the dividend date or whatever, probably is not per se reportable. But you have to understand the overall structure, because it usually is one securities lending transactions, especially for hedge fund managers. They have quite complex, or you have to understand the trading structures of really trying to go forward. And of course, they can pick certain, let's say, elements to conduct their intended, let's say, text-driven structures. And if you have understanding thereof, that's let's say, from a knowledge perspective, this may raise concerns. But the individual, let's say, transaction as such on a standalone basis, due to the fact that it's standardized, etc., will not trigger, let's say, any reporting issues. So, but if you understand the overall, let's say, trading intentions, etc., if you, let's say, advise on these, or if you, let's say, Germany has not implemented, this is different, let's say, from other jurisdictions, the ancillary intermediary. So only if you have, let's say, if you're a fully fledged intermediary, to put it this way, and you really understand the structure, then you have to, then you will get into, let's say, the risk, or let's say, have to analyze your reporting obligations. But individuals, let's say, transaction as such, loan agreement, securities lending, some sort, I would be reluctant to let's say, announce that this is already triggering, let's say, reporting issues. No.
I won't quote you on it or rely on it. I'll come back and put a fact pattern in front of you, Robert, so don't worry. John, I wanted to just ask, I mean, sort of like, I'm just in the last few minutes of the webinar. What are the practical things that, hedge funds, their managers and administrators and prime brokers, they should be doing in getting ready? I mean, sort of like, I know we're talking about we're at the 11th hour, but if they haven't started, what should they be doing?
Well, I think initially the first most important thing to do is an impact assessment on the business and the products. Are you seeing any aspects of those products becoming, concerning from a DAC6 point of view? Because, the hallmarks are not all driven by the main benefits test, only some are. And you could even have aspects of a main benefit in something that you're doing, but then you have to look at the reason to know. Do you have enough information, in your possession to sort of say that, yes, we've got a problem? So the impact assessment is the most crucial thing, first of all. Then I think it's down to looking at how you would have an escalation process if you were to find something suspicious. But this goes across your onboarding, it goes across your front office activities, and it's also as well. It's important to have training on general aspects of tax avoidance and evasion. Why DAC6 is there. There's broader things like corporate criminal offence and all that, that's out there now. So introducing a training module for non-tax trained people to at least have an understanding of what it is you might be asking them if you're talking about DAC6. So it's impact assessment, escalation process and sort of socializing the tax aspects of tax avoidance and evasion in a way that people find it easier to digest and get the core principles of it and how it could impact the business.
Yeah, thank you very much, John. And that's essentially, what we're doing at the moment. And I would just add, which we discussed earlier on, is also the communication protocols are really, really important, both within and with external counterparties. I think that's one of the key things.
Yes.
I'm just going to give you 1 minute, Robert, which is what happens if it goes horribly wrong? Are there penalties there?
Let's say for the backlog, in Germany there are no penalties, and let's say from the tax authorities, they clearly let's say expressed their view. They are on a learning curve too. So there's currently, let's say, the taxpayers, the intermediaries, and the tax authorities are learning how to go forward, what is really of essence to report, etc. And if you have some sort of misreporting or misreporting, you can correct it as quick as possible, and that is always a solution. So
that sounds like a really easy regime. Then is that what you're seeing in Luxembourg and Poland as well?
Poland, I would say, what I hear from my Polish colleagues, this is a little bit completely different.
It definitely is.
The penalty levels, etc. So there you have to report everything and have some experience with, let's say, working together with our Polish colleagues. This is very, very formalistic, and you should stick to the very, very formal approach of the Polish tax authorities. I think from our Luxembourg colleagues, I understand, let's say, per se, they are quite, let's say, penalty or the potential level of penalties is very significant, but in reality, it will might be different. And there is no very specific guidance yet how to interpret, let's say, the DAC6 regulations. So therefore, there's a lot of, let's say, opportunities to discuss different views with the tax authorities.
I mean, the UK has been quite generous. They've given us £5,000 per each report failure. But if it's systematic, then it goes up to 1 million sterling. I think the Luxembourg guys is about €250,000 per failure. But as you say, it's if you have the systems and controls, you can avoid that. But I do like the Polish because I think they not only is it €6 million, but they also arrest you for good measure. So I think that's, be careful in Poland. But thank you very much, gentlemen. It's been a pleasure having you. And I just going to sort of like say that for the audience that do continue the dialogue with us, we will be hosting a webinar on main benefit test, which I would definitely recommend to you. And please do click on the prompt to register for future webinars. And with that, thank you very much to our panelists, and thank you to our audience. Goodbye, stay safe.